right, with that, let's quickly move on to our next guest of the show. We have market expert Sunil Subramaniam joining us. Sunil sir, good morning. Now that the Fed has announced the rate cut, will RBI follow a similar path?
Not necessarily, because I think RBI front-loaded the rate cuts well before the Fed did. I think this governor has already done 100 basis points. So there's really no pressure. Plus, if you recollect, the Fed has actually discounted any future rate cuts immediately. So to that extent, it's not a continuing rate cycle on which the RBI has to worry about the differential in that. Second is that until the tariff problem is solved, RBI would still like the rupee to depreciate a bit, to the extent that the rate differential between the Fed and India widens a bit. There will be the pressure on the rupee, and it's a counter tariff move for us to allow the rupee to weaken. We have already allowed that 5% this year. So I don't see that this particular Fed decision is going to trigger the RBI into a rate cut.
Okay. All right. Sunil sir, we have seen that, US and China, both the leaders are going set to meet today and, of course, discuss about the trade contours as well. India still has to finalize the trade contours with the US as of now. But at this point of time, do you see FI conviction more leaning towards China? Because so far this year it has been.
I would say that will continue until there is good signs of an interim trade deal, at least with India. So I think that clearly China is a much bigger worry for America. They had run a $400 billion trade surplus with America. They have tightened controls on rare earths. They have reduced their soya buying from the US. So US is hurting from China. So I think that there is an imperative for Mr. Trump to sort out the China issue sooner, because both sides can hurt each other. So there'll be a lot of blood on the street, and that will spill over to everywhere. Now, from a China perspective, from FII perspective, the reason they've been putting in China is not just this that the trade deal can happen, but it's more to do with the valuations of the Chinese stock market, which are still significantly cheaper than the Indian stock market. And hence, I think that I don't think, really speaking, FIIs decide between China and India. I think India standalone, the trade deal is important to justify the valuations, because the future growth of the country has to come from export, and you cannot ignore America, 30% of the world's GDP with a $90,000 per capita income as a potential buying market. I think so. FIIs earlier, prior to last year's September, had been betting that India-US relationship would grow, and the India trade with the US will grow, and we will substitute China as the China plus one. All of that came a bit crashing down because of the tariffs and the way the situation panned out, right? So that's where the future growth prospects of India, going up from a 6.5 to 7 to an 8-10% GDP growth rate, that's got hurt because of the tariff situation. And so I think that with India specific in mind, for FIs to come back in a big way, we need to see some resolution on the trade deal. And the reason it's not so happening is because there are sharp red lines there in terms of India buying oil from Russia and India not allowing access into the agri and dairy markets for the US. So I think that has a big hurdle to be solved. And, one hopes that you can leave that on the table and put an interim deal on the table. That's also something the FIs would welcome. So let's keep our fingers crossed on the trade deal front.
Okay. So, sir, what about with India diversifying away, buying more oil from the US instead of Russia? What does it mean for imported inflation? Are we pricing in the risk yet?
Well, if you look at it overall, the scenario for oil is actually very weak, because I think the OPEC is stepping up supply, and any resolution of the tariff and all of that. So the point is that I don't see that oil is a big risk. Now, if you buy from the US, right, the US is, we buy LPG, we buy gas from the US. So not necessarily crude oil. The prices are related. The second is, Texas crude, which is the US crude, is priced always cheaper than the Brent crude. So to that extent, buying more from the US doesn't necessarily mean that we'll pay a higher price or a risk in that. But the key is that ability of our refiners to use US crude is limited. I think we import currently about 10% of our requirements from the US. And in terms of dollar value, I think that there is scope for another $12 to $15 billion of energy purchases from the US. So I think that that's one way. Definitely in the trade deal, India will have to commit or soft commit that buying of that oil. But I don't think we can go beyond that because we can't process that crude the way our refineries are constructed. For us, only the Ural crude from Russia or the Saudi, only that's what we can process. There is a limited capacity and we'll use that fully for the trade deal, yes. But don't see that as a risk because India buys oil from A, B, or C, and oil prices are largely decided internationally. So it's not that US can say, oh, I'll supply you oil and I'll charge you a premium for it. No, it's a market driven prices.
Okay, okay, all right. Sunil sir, coming back to earnings, which sectors are you seeing there would be some double-digit growth visibility? Because the street is eyeing for the second half to be better than the first half itself. But from a sectoral perspective, anything that you're watching out for?
See, for me, it's the banks which will drive the whole story, right? Because the loan growth numbers have been good. And I think that they've passed on most of the rate cuts. About 75 bips of the rate cuts has been passed on. So I think from now on, there's only a further 25 bips rate cut. And my sense is that they will pass that on in the deposits before they go down to lending. So I think that their margins also. So for me, because they are 35% of the index, not just the Nifty, but in the MSCI India index, it's about 35% is financial services. So I think they largely determine the way forward. Second is that with the oil prices, I think the oil energy segment is also somewhere where the refining margins are key to look forward. So these two are big. Now, from a third big segment where I'm looking for is the IT space because I think that IT because of the fact that it's oversold on the market, right? And they have got a very pessimistic view about IT. I think any beat on that front would be welcome by the market, and I could see a rally because their expectations are very low. That comes from that. So I would say these are the three major. From the consumer segment, this quarter, I don't want to look at the numbers for now because all the sales that's happened, whether that's happening at an improving margin or they were forced to reduce margins to achieve these record festive sales numbers, will be known only in the January quarter. So on consumption, I would rather ignore the results for now because there's only about 8 days of sales from September 22nd, right, Navratri onwards. That's there in this quarter's numbers. So I would not lay too much stress on the consumer related companies numbers for this quarter. Rather wait for next quarter for having a call on that.
Okay, okay. Now that you mentioned about the consumer-related companies, but do you believe that the much of the rally which is done in the auto space is already done, and now it just the investors must be watching out for the earnings to trickle in from the second half?
To some extent, what you say is true, but I still believe that with a January, there's going to be a pay commission release, so there's going to be more money. And typically, March, there's a depreciation related. So all small businesses and all will like to buy their vehicles before March. So generally, March, April is a big season for the auto. So I would still say that there's still some more juice because the people the GST cut has helped the decision. The EMI cuts have helped the decision. But people also look at depreciation. People also look at those things, right? So I think that you will still see in the JFM quarter some demand for vehicles to come through because of the depreciation effect. So April, May, June earnings will tell you really the story. So auto, yes, a lot of the future growth is in the price. There's been a strong rally, but I don't think it's fully done. There is a little more left, I would say, at this point in time.
Okay, okay. So, Sunil sir, what about the cement sector? Of course, we've seen resilience in the September quarter. Last quarter was also good. But usually, October is the month when the festive period is on. And of course, it's a seasonally weak month for the cement space as well. Do you expect the GST cuts, which has been announced, to offset any of the impact?
Yes, I do. I'm positive on the cement sector, not just from the fact that the GST cut ultimately this will translate into better housing prices. So linked to cement, I'm also looking at the real estate space, and where I see that right now the real estate space has not yet really picked up that because it's still a high-end real estate market. But I think that with the GST cuts and the EMI cuts, the affordable housing space is the next space that will show a good growth, for which the real estate people, developers have to go and identify new parcels of land and launch affordable housing projects because there's a supply and a demand issue. So when that comes through, which give it a bit of time, maybe 6 months more, right? Then cement is obviously a key element in the real estate and construction sector projects. So I think that the demand side for cement will grow and real estate will also show a good growth in the next year. So I look at those themes in a together fashion.
Okay, okay. So, Lisa, just one last question before we let you go. I mean, the street is watching out for Nifty to mount above that new high levels as well. But the to sustain above that 26,000 is quite a struggle for Nifty. But what are you watching out for? I mean, is this the month going to be the month when Nifty can achieve its fresh lifetime highs?
I think this is the trade deal month. With Mr. Trump, every day other is speaking about a trade deal. And I think Mr. Anantha Nageshwaran, the CEA, quite a month or two ago, had said by November 30th, we will have a trade deal. So I think if this month the trade deal gets signed in whatever form, if they can lay out some of the tough parts for a later deal, but an interim deal is announced, then Nifty will break out of this 26,000 logjam that is stuck in and reach newer highs.
Okay, okay. All right, with that, we have to let you go, Sunisa. But thank you so much for your time, and we hope that we connect with you soon.
Thank you.
All right, let's take a quick check of the markets of where we stand.